Did you know that NFL football teams, head coaches know if they're going to win the Super Bowl, the big game, one that happens every year, February, first week of every year, they're going to have an outstanding defense. And if you look back historically, very seldom an offense game won. And when I think of good defenses against good offenses, I always think of the Pittsburgh Steelers, and I also remember several years ago, the Atlanta Falcons was up like 24-3 or 28-3. I can't remember exactly the score, but there were 3 or 4 scores ahead of the New England Patriots with just a little bit more than one quarter to go. So in other words, that game was pretty much nipped in the bud. And the game plan for the Falcons was to keep Tom Brady off the field, and they succeeded those first 3 quarters. The team that actually beat the Patriots in the undefeated season was the New York Giants. Now, this has nothing to do with football. This has everything to do with retirement. And where am I going with this? Well, Atlanta kind of figured they were going to coast through the game. They only had 1 quarter to go. Well, all of a sudden, the Patriots started getting a little bit of momentum. They got a score in by the offense, and they got it pretty quickly. Tom Brady does what he does best. And then they made a couple great defensive plays. I don't know if you remember, but I do. And those 2 defensive plays got this team back into the game to the point, as y'all probably remember, it was one of the most miraculous comebacks of all time. And a lot of it had to do with defense. Defense in retirement equally is important. Because if you think about it for a moment, most financial advisors today, and that include me, and I'm saying this, and I'm pointing 3 fingers at myself, because we're in the business to help people with their money. And one thing that I have learned over the 19 years is the reason people's balance diminish and gets reduced is a lot of it is because they don't have enough defense when the markets actually turn and start going south. I mean, if the markets are going to go to the moon, you have nothing to worry about. And if you look at past historical evidence, the markets always goes up. Well, believe it or not, that's not necessarily true. The markets don't always go up, even though over time they do. You got to ask yourself, there are pockets of time or sequences of time where the market doesn't generate any return whatsoever. And those are, if those type of market fluctuations was to occur while you go into retirement, which you and I don't know what the markets are going to do going forward, then you don't have the right defensive mechanism to get you through retirement. Because at the end of the day, you want defense because you need income. And most people we work with typically need 4 to 5% of their portfolio each and every year. You need that to provide you income, 4 to 5%. I'm just talking about if you had $1 million, that's $40,000 to $50,000 to add to your Social Security so that way you can do the things you want to do. Well, the reason that you want to invest for defense, and more than likely you're not investing for defense, just in case the markets doesn't exactly cooperate like you hope or what you envisioned. Yes, I'm a big fan in leaving my money in market-based investments. Stocks over time do go up. But you got to also understand market history says that markets have a tendency also to be flat. There are patterns. So if you look at these patterns, total return equals I plus G. This is a component of what makes up returns over time. Well, I don't know about you, but I've always been told the markets typically average about 10% a year over time. Okay? So if I'm going to invest my money 10%, I'm easily going to keep up with inflation. But did you realize that 2 to 3% comes from dividends, and the other 6 to 7% comes from growth, capital appreciation? 2 to 3%, the dividends, that's the bird in the hand. That's going to happen. This is may or may not happen. This is capital appreciation. So if you add these two together, that's how you come up with 10%. But the defense is this component right here. And so the question is how can you increase your income to give you more defense just in case this doesn't work out for you? Because if you look back historically, the markets have had patterns where the markets that do anything, they had ups and downs. At the end of a certain cycle, there was no growth whatsoever. And so if you go from 1899 to 1921, for 22 years, there was no growth. Then we had the roaring 20s from 1921 to 1929, where we had 8 years of double-digit growth. In other words, growth was, the markets were going up. Everybody was high-fiving in the streets. Then we had the Great Depression. That lasted 25 years. Again, ups and downs, fluctuations, and at the end of the day, there was no growth. And then we had a 12-year, another bull market. Bull markets means the markets are going up in an upward trend. Flat zero return markets means they're like a jagged sawtooth, but typically they're flat over time. Then we had 17 years, 1966, 1982, that was high inflation period where interest rates, most of you probably remember, borrowing rates were at 12 to 15%, mortgages, CD rates were up to 12, 15 or more percent, and so forth. So that was this period right here. Then we had the raging bull market of the roaring 80s and 90s, where the markets were more than just double-digit returns. It was the best time ever, and where probably most of you built your wealth. Then we had 2000 to 2013, which was the shortest bear market, and it was again zero return. And y'all probably remember it was a W-shaped recovery. It took 13 years to recover, and then of course right now we're right around 11-year bull. But if you'll notice, the average between these right here is about 20, 21 years, and the average bull markets are about 13 years. So if you look and if you add both these up, that's about 30 plus years. So in other words, if you go in retirement and you're going to be in retirement for 30 years, you're more than likely going to have a bear market where you're not going to get any returns, and then a bull market as well. Question is, which one of these cycles are we in now? Will make all the difference. That's the reason why our clients are investing for the I, the dividend. In other words, you want to get the dividend up. So that way you can rely, because if the markets go down like 30 or 40 or 50% like they did in 2000 dot-com bubble in 2008, you have a defense. Because the name of the game is to beat inflation. There's nothing wrong with being in stocks. You don't know whether you're going to go up or you're going to go down in the stock market itself. You can stay in the stock market, but add defense to your portfolio, and you should be able to get right through that cycle, ever how long that it may last.